Good day, and thanks for joining us for our webinar focused on managing your farm in challenging times. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture. And joining me today are my colleagues, Dr. Chris Hurt, Professor of Agricultural Economics, Craig Dobbins, also a Professor of Ag Economics, and Michael Langemeier, who's a Professor and the Associate Director of the Center for Commercial Agriculture. The environment in crop agriculture has changed a lot over the course of the summer, and we're going to talk a little bit about some stage setting with respect to the changes that have taken place, and then draw some inferences about what's taken place in the land market, cash rental rates, as well as land values, and then look ahead to some projections for the 2019 crop year. We'll also talk about some marketing strategies to consider for corn and soybeans coming off this 2018 crop that'll be harvested here in just the next couple of months. So with that, I'm going to turn to Chris Hurt. And Chris, you spent some time thinking about what's taken place and the changes that have occurred. But you know, if we think back to last spring, and I'm thinking back to the month of May in particular, things were starting to look better in crop agriculture here in the Corn Belt and especially here in the Eastern Corn Belt. But things have changed a lot. Let's kind of review why we were getting a little more optimistic this past spring, and then we'll talk about the changes that occurred this summer.
Well, I think our audience clearly remembers this. We came into 2018 actually building some optimism. It really had been the 2014 to the 2017 crops. We had had low prices and we had had low farm incomes, and we'd seen a lot of adjustment that occurred around the world to get our supply kind of in line with demand. So as we look back to the spring, we really thought we were making a turn to where we'd gotten a lot of the fundamental adjustments made. We saw a very strong U.S. economy. We saw a strong world economy. That's the demand side was looking very good. And we'd gotten our balance sheets in better balance, if you will. We'd gotten our inventories down. And farmers sure didn't miss the fact they had the chance to sell some beans at $10 a bushel for new crop and a little bit over, and corn right around that $4 mark. Now those were levels that Michael has talked to us about. At least some of the lower cost farmers could hold things together with $4 corn and $10 soybeans. So I think that optimism was very strong, but that changed.
Changed dramatically as we got into the month of June, and really there was two factors that were driving the change. One obviously was the concerns about tariffs and the impact that was going to have on U.S. exports to China in particular, but also to Mexico and some other countries as well. And then the other factor, of course, was the change in the weather patterns. In May, we were worried a little bit about some dryness, some concerns about possible drought, at least pockets of drought in parts of the Corn Belt, and that having a negative impact on yields.
I remember Argentina got into real trouble on their soybean crop and major reductions. So there's quite a bit of enthusiasm, if not bullishness, in the market at that time.
We turned the corner. The weather changed. Most of the Corn Belt has had a very good growing season. Yield prospects are very positive. Yield reports seem to be increasing week by week almost, it seems, and based on the crop condition indexes. So talk us through a little bit of the change we've seen over the course of the summer.
Well, and I think, again, our viewers know the kind of changes. I think we have a visual that helps us to give us at least an illustration of the impact on the bar chart there of soybean prices. So we see that huge decrease from 1060, this is November new crop 18, huge decrease from 1060 down to a low at 826, and that's a short period of time. That's roughly early June going into the middle of July. So that 5 to 6 week period taking 20% out of the prices. Now we've seen some recovery since that. This was done a day or two ago, and actually down to about 875 on that November futures here today. But we look, as you said, at what drove that. Good weather is a driver to lower prices. We know that's one of the facts. But the Trump administration tariffs and then the retaliatory tariffs, particularly two kinds, one from China on soybeans, wheat, corn, beef, pork, poultry, dairy, and then Mexico 20% tariff on pork. So as we look up in the upper right-hand corner, we can look at the farm commodities that the Trump administration and USDA have identified as worthy of receiving some payments to compensate for the problems, the lower prices created from the tariffs. And these were prices as of yesterday. Soybeans were down 14% from the 1st of June, corn and sorghum down 9%, wheat down 5%, cotton 10%, hogs 11%, and milk 11%. So when we talk about the $12 billion that the Trump administration is going to try to come up with, Secretary Purdue has suggested $7 to $8 billion of that would be these direct payments for these 7 commodities. So this has sent all of us ag economists kind of racing to try to think, how will USDA do that evaluation? How will they allocate to the crops? How many dollars will that be? And then how will they allocate to the producers? Now, we're not going to speculate a lot about that, but I think those payments could be really measurable and a help on the cash flow this fall. We may hear some word as early as this Friday on some of the direction, and there's been some promises from Washington and USDA that maybe that first week of September there would be some more details. A lot has changed.
Yeah, a lot has changed indeed. In fact, one way to look at it, Chris, and I think this is a chart you put together, is to look at the change in soybean prices in the U.S. versus Brazil. So let's take a quick look at that.
Yeah, this is very interesting, I think. And again, what happens when China puts a 25% tariff on U.S. beans going to China? A 25% tariff is just a tax. It just says to unload those beans, you have to pay a 25% additional charge on the delivered cost of those beans. So on $12 a bushel delivered price to China, that's $3 a bushel. So what you would expect is U.S. origin beans to China just aren't as valuable anymore because that tax has to be paid. So what we're looking at here are 2 lines. This is just looking weekly back to the start of the year. The green line is the price at our, let's say, New Orleans Gulf price U.S. delivered to the Gulf. The brown line is a port in southern Brazil, one of their main export facilities. As we go back and look at the start of the year, the brown line and the green line are pretty close. This makes sense. Loaded vessels ready to head to China, to Europe, etc., of soybeans. Price pretty much the same in Brazil or the United States. I've got marked there about the middle of the graph. In early June, Brazilian port prices and U.S. Gulf prices were very close to the same price, around $10.40. Then we get the talk about the tariffs. They actually go into place in early July, and you can see what happened to prices. This past week, when we looked at these price relationships, Brazilian port prices were $10.50. The U.S. Gulf, New Orleans, was $9. The U.S. price had dropped $1.50 relative to Brazilian beans. This is the impact of the tariff. In China, Brazilian origin beans are just simply more valuable than U.S. origin, and we're seeing the price differential change. Now, this still doesn't make U.S. beans competitive going to China, but guess what? It makes them, U.S. beans, really competitive going to Europe. So we've actually seen the Europeans and some other buyers in Asia be very aggressive at buying old crop beans, and exports have actually been very strong on beans. You would expect that. We're reorienting how we ship beans around the world, but the dilemma for our U.S. farmers is, my goodness, beans have dropped $1.50 relative to Brazil, and they're feeling that in their pocketbooks with their local bids.
And I guess we're not going to dwell on this, Chris, but from a longer term perspective, one of the things this does is encourage even more soybean production in South America and Brazil in particular, right? Going
well,
forward.
You can see that on this chart. If Brazil is going to trade $1.50 a bushel higher than U.S. because they're favored in China, then certainly over time, the longer tariffs stay in place, the more the damage becomes permanent because Brazil puts infrastructure and new land into production. We're even going to see an expansion in Canada of soybean production if these tariffs stay in place. All non-U.S. producers will be favored over U.S. in China, who's the big world buyer of soybeans.
So from a long run standpoint, there's really a short run and a long run aspect to this. The short run is very negative on U.S. farm incomes. Long run, it stimulates even more competition for the U.S. ag sector.
That's right. And so the ag leaders have really worked with the administration to argue and make this point that trade disputes, the quicker they can be settled, the better for agriculture. The longer they go on, the more the changes become permanent.
Yeah. So, Chris, let's take a look, and a lot of our viewers have on their mind what they're going to do with the portion of the crop that they're getting ready to harvest that they have not priced. And as you pointed out, there was some pricing that took place prior to June 1. Some of the people in the trade have suggested that there was more pricing that took place this past spring than in some prior years, so that's good news. But still, a large portion of this 2018 crop has not been priced. So you've taken a look at possible storage returns, both on-farm and commercial, for both corn and beans. Let's kind of walk through that.
Yeah, so yesterday we looked at what is the market offering in terms of what we call the carry. That is, how much higher is the price bid, say, next May or next June or next July relative to today. Then we've backed that off for on-farm storage. We've just charged interest on-farm storage. So what we have here is a graph looking at on-farm storage, the blue line at the top, off-farm or commercial storage, the red line at the bottom. You can see the horizontal black line that represents a zero return. So on the blue line, we're looking at the return to storage after interest cost on farm, and we see that nets out 25, 26, 30 cents a bushel into the spring of 2019 or very early summer into June. Now again, that's what the market was offering yesterday in central Indiana, looking at the premium bids or the carry in the market for the cash bids, and then taking interest cost off of that. The red line at the bottom is below zero, that's commercial storage. I added 15 cents flat charge till January 1, then 3 cents a month after that. And what you see is in commercial storage, the market was not reflecting yesterday enough premium bids over time going through the storage season to pay the interest cost on commercial storage, plus that flat charge, and then the 3 cents a month after January 1st charge. Now what does this say? It says the market's offering right now something in the range of 25 to 30 cents for on-farm storage that I could planning to store on the farm and maybe sell out for June time period. And after I net my interest costs, I could gain about 30 cents a bushel versus harvest time. So that's a pretty good return. That's fairly normal to on-farm storage. On commercial storage, what that is suggesting is that the market's not offering enough premium. I'd still lose about 5 cents. It doesn't say you don't store commercially, but you're going to have to get maybe a 5-cent appreciation or speculative gain in the prices coming up to cover your storage cost. So if you believe storage prices will rise more than 5 cents on corn, which I think could be likely, commercial storage isn't such a bad idea.
So to be clear, Chris, when you look at the blue line on the chart, what you're really looking at is the carrying charges that are built into the deferred
cash
futures
bids
prices
already, right, and the futures. Right.
And if you're looking at the futures, you're assuming, particularly as you think out to like next summer, a return to a fairly normal or typical basis pattern, right, as we move through the course of the year.
And corn's pretty normal at this point for its basis pattern. We've got there in the yellow highlight futures premium yesterday from December to July was 25 cents, and the basis bids were gaining about 15 cents from, say, a 30 under at commercial facilities to 15 under next summer. So that's a 40 cents a carry minus your interest cost on farm. That's where we're getting the 25 to 30 cent net.
Okay. Let's take a look at the same kind of analysis, but this time for soybeans.
Yeah, soybeans, something jumps out at you. First, that blue line, 45, 50, almost 55 cent return above interest cost on farm. And even the commercial storage space, 15 to 20 cents of return above total cost, and that includes interest cost commercially, that flat charge, and 3 cents a month. So it's unusual to see this on soybeans. What's going on? Well, the carry or the premium bids are quite a bit higher next spring and summer than they are at harvest. Or can I say it another way? Harvest bids are horrible. I just looked here today. We closed 8.72 on the November futures. We have bids in Indiana that are now below $8 a bushel, in the high 7s on some beans. I saw one in southern Indiana, not too far from the river, at 802, 70 cents under. Now the processors, and the reason for this is the concern about who's going to buy the beans. Now we're going to sell a lot of beans, but when China our trade with them is disrupted, we're going to sell to others. Brazil's been selling to Europe. We'll sell more to Europe. Brazil will sell more to China. All that's going to go on. But there still is a concern of there's a lot of beans. We have very good yields. We have record acreage of beans. There's going to be a record crop. And who's going to buy that? And right now, the grain industry is penalizing that with a very low basis. So we have crushers that are 30 to 40 under the new crop bids, right, for new crop bids. Country elevators, 40 to 50 under. Some are 60 under. And as I said, I just saw one that was 70 under here in Indiana. So really depressed harvest basis, but then getting back to more normal basis as you get into the first of the year, January, February, March, and going into the spring. So this gives us, as you see in the yellow shaded area, that carry is almost 80 cents a bushel now. That's very unusual on beans. 44, 45 of that's coming in the futures. That's November to July premium. And then I've got about 35 cents of basis appreciation. Normally it's about 15 cents. So store beans is what that is saying, and the market will pay you. If you want to store them priced, you store them and sell them for delivery next May or June. Sell them at harvest when you put them in the grain bin next May or June. Pick up 50 cents or more a bushel above on-farm storage interest, and commercially maybe 15 to 20 cents. That's very unusual to see commercial storage, the market saying we'll pay you for commercial storage. The point being, the market is very uncertain what the demand structure is going to be this fall with these tariffs in place.
And I think the corollary to that is it's going to take time to sort out, and that's really what the market's saying, right?
I think that's right.
An expectation that next spring we'd see that.
The basis bids return to more normal out there someplace Jan, Feb, March. It's almost like the market saying, hey, the tariff issues are going to be solved maybe by the time we get to the first of the year. Now again, that's a little bit extra to read into the futures market and the grain market, but it could be an explanation for why so low at harvest and then getting back to more normal, at least into the spring and next summer.
At least figuring out where the trade flows are, right? I think that's what the market's really trying to tell us, is by next winter and next spring, we expect to see these trade flows start to sort themselves out, even if the tariffs remain in place.
Yeah, I think that's exactly right. We don't know how that's going to happen. That means there's uncertainty in the market. And if you're a grain buyer, that uncertainty is reflected. I'm going to offer a lower basis.
So as you think about these two charts, very strong incentive. We always talk about allocation of storage space. Pretty clear that the allocation of storage space goes to soybeans first, followed by corn.
Well, and I think that is the case particularly this year, and oftentimes producers look at selling beans at harvest a little more than corn. They tend to like to store corn. The signals this year are exactly opposite. Store the beans. And again, if we could get a resolution on the tariffs, we're going to get a bump out of that in prices as well. If we don't get a resolution on tariffs, then it's kind of storage is a high-risk strategy this year. We could go lower, but again, most farmers are going to say, if we're already in the high sevens on cash prices, how much lower can we go? I don't want to answer that question.
So one of the things you looked at that maybe helps play out here with respect to what's going on with these storage returns is storage capacity versus storage requirements or needs here in Indiana.
Right. And again, one of the reasons that basis could get extremely weak is we just run out of storage space. If there's no place to store that, then generally what the grain industry says, the only way we'll take your beans or corn is you have to sell them. If you sell them right now, we can move them through the system, move them right onto the crusher or the exporter. And so storage availability is very important, often on basis. So the question, we've got record yields on corn this year. We've got very high yields on beans, may end up being a record, and certainly a record total crop of beans. Is there going to be enough space? The answer to that in the Eastern Corn Belt is yes, there's going to be enough space. The reason is we planted so many soybeans this year. So our acreage of beans is way up, our acreage of corn is down, and corn is the big yielder that takes a lot of storage space. So we do have enough capacity. Looking at the chart here in 2018, the red, there's 2 bars there over 18. The left hand is the storage needs, so that takes the carryover plus the size of the crop we're expecting here for Indiana, and compares it to the green bar, how much storage capacity is there. And the green bar is higher. It says we have enough capacity to handle this crop. That storage, while it may be tight in some areas, overall we've got enough capacity to handle it. So again, I think the grain industry's been concerned about that. I would say that's not going to be a concern. Could it be even a reason on the bean basis? The bean basis widens out right now in anticipation, but when we really get to harvest, it strengthens up some.
Yeah, good point. Well, let's kind of summarize that on the marketing strategy
side. Kind of
side.
Looking at current prices, what might be the cash price range across the storage season on corn. We said $3.40 to $3.80 a bushel, and everybody says, well, we're going to get back to $4. Well, to get back to $4, we've got to have some speculative gains, some higher prices, and I think could be the case on corn. Inventories are tightening. World inventories are pretty tight, and demand looks strong on soybeans, on corn this year. I think we've got at least a 20-cent upside potential. Then if we could settle the tariffs, everybody get that if, then I think corn probably has some movement to the upside just on that factor, maybe 20, 25 cents. So if you get both of those, the strong demand that we think we're going to see really develops in this fall, and we'll see that in exports and in feeding use, etc. That we can get 20 cents there, 20 more cents or so with settling the tariffs. That gets us back to $4 corn scenario. Storage, we said on-farm storage, unpriced. I'm a little bit friendly overall to prices speculatively coming up. And commercially, we'd say, well, be careful on commercial storage. May not cover your cost. Another strategy would be sell the cash, buy futures to replace, or buy some call options. Again, this would be up to the individual's decisions. Then on soybeans, current markets would say we'd go down in the lower $8, maybe up to $9 by the time we got into spring or summer. On the other hand, we're looking at a record crop in production in the U.S. this year. We're talking about South America booming back. Brazil's going to be up 7% on acreage. With higher acreage in Argentina and restoring to normal yields, they're going to be up over 50%. We're looking at over 800 million more bushels of soybeans in South America. Record U.S. crop, record South American crop. We could really see trouble for the bean market. I'm saying you could drop beans another 40 cents. That gets you down in that high $7 range up to the high 8s. Settle the tariffs, add $1.25 to $1.50. There's your scenario that could we get back to towards the high 9s, $10, settle the tariffs, do that early, possibly. Storage, then on-farm storage for soybeans and commercially, and I think that's your choice. If you want to store them unpriced, hoping the tariffs get settled and we get a nice recovery, that would be one thing. Another low-risk strategy would be store them on-farm or commercially and forward price them, take the carry that's in excess of your storage cost, and just add that to your harvest price.
So storage is going to be key either way you look at it, right,
Well,
Chris?
I think a lot of producers are saying the tariffs have been devastating, particularly to soybean prices. But you know, I sold some soybeans and corn earlier this spring or very early summer, and I got some good prices there. If I can avoid selling at harvest time while the tariffs are still in place, wait it out and hope that we get the tariffs settled, and then I can get some better prices. So that it is a strategy that I think a lot of farmers are going to be thinking about. Storage, 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 if I can avoid this time period. This leads to the question of, well, how long are the tariffs going to be in place? And obviously, there's a lot of speculation and a lot of thoughts on that.
Yeah, we don't have any definitive answers there, so I think keep tuned on that one. Craig, let's turn our attention to land values and cash rental rates. For many years now, you've been conducting a survey in June of each year and also a smaller one in December of people here in Indiana. And so share with us some details about who you survey and how that process works.
Okay. So the folks that we survey are people that are, by the position they hold in their career, have to work kind of with the farmland market on a daily basis. So this is agricultural lenders, professional farm managers, rural appraisers, and farmers. Okay, so just by being close to the market, our thinking is that, you know, they know pretty well what's going on in the market and where prices are at for farmland values and cash rents.
Okay, so you've got some data because you did the survey again this past June. Here's some of the results on the state averages.
Yeah. So June seems to be a favorite time for things to change these days. And as Chris has very well pointed out, it was that way again. Okay, but for this year, the farmland values in Indiana were up a little bit. Now, I tend to be a bit of a pessimist when it comes to these tight margins that farmers are facing, and I really didn't think we'd find an increase, but we did. It was a small one, but across our various land qualities here, we got an increase of 1.6% to 2.4%, and there are certainly other areas in the Midwest where changes of this magnitude have occurred. Iowa, for the last couple of years, has had an increase in farmland values in this area. But there are also areas in the Midwest where states are still reporting significantly declines in farmland values at well. So, you know, in general, I think in the Midwest and in Indiana, the market's still a bit unsure about which direction farmland values are going. We've got some signs that we'd kind of reached bottom, but then June happened. And now we're really not sure if we've hit bottom or not with farmland value changes.
Yeah, and so your survey was done in June when the midst of the declines that was taking place in soybean and corn prices and some other commodities as well. And I guess I wonder a little bit when people were filling out the survey and responding to that survey, how many of them were actually thinking about conditions in maybe the prior 5 months versus what was unfolding in the middle of June?
Well, I suspect that the prior 5 months probably got weighted a little heavier than what was unfolding right at the moment. You know, when we get price drops as dramatic as we have, it takes a little while to digest them and sort out, you know, is this something that's a temporary happening, or is this going to be a more permanent thing? Well, I think we've gathered information now and have a little better feeling for that, but you know, I'm sure both were on their minds. I can't tell you which one they were weighting most heavily.
Right.
But you know, that's kind of agriculture. You know, things are always changing.
Right. So, looking at those changes, you also looked at changes relative to last December, right?
Right. Yeah. And so here's a chart that breaks the year into two halves. And again, the year I'm talking about is from June to June here. And so June to December, farmland values were up, you know, 1.7 to 3.1% here. But then, and that was, you know, kind of, I think, based on the optimism that Chris talked about, that we, you know, hopefully had kind of turned the corner, that the fundamentals had kind of gotten adjusted so that it was, you know, better prices were on the horizon, we thought. But that kind of evaporated in the latter part of the year. And so from December to June, we had small declines in farmland values for that part of the year. So we started out hoping things were getting better. We kind of ended up in June this year wondering what happened.
Yeah. So as I look at the survey, I was a little surprised to see that all of the increase was centered on the first half of that 12-month span, and virtually none of it on the second half. That was a little bit of surprise to me, in part because of the strength we'd seen, for example, in commodity prices this past spring.
Yeah. This is kind of the second year we've had this phenomenon go on, and I think part of it may be explained by the size of crop that gets harvested. You know, the last couple of years we've had pretty good yields in Indiana. Yeah, prices are low, but we had a lot to sell. And then this year it looked like worldwide things were getting more into balance. So we thought there would continue to be some price strength there. But again, tariffs got in the way of this, and so now we're back trying to figure out, well, just where are we and where are we headed?
So one of the questions you ask the respondents to the survey is you ask them to do some forecasting, right?
Yes.
So we've got a chart for that as well.
Yeah, and so here's pretty much the same chart, except the first column now is our December to June period, which we'll call an actual. And what do they expect to happen in the next 6 months? Well, it's pretty much the same. Not much uptick in farmland values expected. If there's going to be a change, it appears they're going to drift a little lower. But you know, changes this small in the farmland market are, you know, this is basically flat. We're just going to sit and wait in this particular case. So
at least that was the forecast in June, that we would essentially tread water here in the last half of the year with respect to farmland values. Okay.
Yeah, and I think, you know, it's not uncommon that when uncertainty goes up, buyers get more cautious, and probably sellers as well. Why sell into a market that's soft or down when I can wait and sell into a market that's more firm and moving up?
Yeah. So for many years you've gone back and asked people what they think the drivers are with respect to changes in farmland values, and actually asked them whether or not they thought it was going to have a positive impact or a negative impact on farmland values. So let's take a look at that.
Yeah, so there are 11 things here that we asked folks about, and the first few all relate to the first couple are income items, and so it's not surprising that they tend to be below the line, which means their influence is negative. And then the next two are prices. The third one in the chart is crop prices. The fourth one is livestock prices, and so those are negative as well. And you know, of those two, the largest change was on the livestock prices, where it got significantly more negative than it was the last couple of years here. So, okay, and then as we go on across the chart, the next one there in the middle is interest rates, and that was one that over the last 3 years really has shifted directions. We got a bit of an uptick in interest rates this year. The Fed's on a pretty routine path now of raising interest rates, and so this long anticipated rise in long-term interest rates appears to be unfolding, and so people have really zeroed in on what's going to happen to interest rates, and that's going to have some influence in all real estate markets as we go forward. Okay. On the positive side, we got to kind of get out towards the end of the chart here. The big positive appears to be the amount of farmland that's being brought to market. Okay, it has, and you hear this discussed amongst people who are followers of the farmland market, that the number of sales are down rather significantly. That people, sellers just aren't queuing up to sell their farms right now. They're kind of in a wait and see position. And so, you know, supply and demand has come into play here. We don't have good measures of how much land is on the market, but it certainly appears that the supply has pulled back. as demand is pulled back, and that's helped maintain prices at levels that are probably higher than they otherwise would be at this point in the cycle. So, and I guess kind of the last change in this chart that I would like to point out here is the last set of bars here, and this has to do with agricultural policy. Usually agricultural policy is viewed as something that has helped lift farmland values. There has been numerous articles written about by ag economists, written to explain how these government payments all get capitalized into farmland and cash rents. The current sort of farm policy we have now, when there are prolonged periods of low prices, acts in a different way than what the old farm policies used to do. They used to be counter-cyclical. Okay, when things got bad, the government payment went up. Well, this one, things get bad, and yeah, short term the government payment goes up, but then it resets and government payments start coming down. So if you're in a protracted period of low prices, the government support payments kind of disappear. Helps the government not have such big outlays for farm payments, but doesn't do much out on the farm for cash flows. And so that's kind of where we're at in this part of the cycle. And so this thing has turned negative.
Yeah, that is unusual from a long-term perspective. And I guess when I looked at the chart, Craig, the part that kind of jumped out at me was that supply factor. You and I were talking earlier today about the fact that if you go back to the 1980s, one of the things that happened was we had a large influx on the supply side of farmland coming to market, especially in an auction environment. We haven't seen that this time around. That doesn't mean it couldn't happen, though, going forward, right? I mean, for example, if under the current environment, we haven't seen any evidence of that, but if this downturn continues much longer, we might see an increase in the supply.
Yeah, that could very well be. And that is one of the very significant differences between the 1980s and this downturn. In the 1980s, farmers were highly leveraged. A lot of farms got foreclosed on. Bankers didn't want the farms, push it onto the market, and just the sheer number of amount of farmland was there really did cause the price to drop. And that has not happened this time around. Farmers are in much better financial shape. Lenders had been more cautious in their loaning during the boom. And so there was better working capital and liquidity in farmers' hands when the downturn came. Now, we've chewed that up, okay? And you can't, and it goes down a little every year. But we haven't reached the point yet where there are widespread foreclosures and land being pushed onto the market for sale.
Yeah. So as you think about the farmland market going forward, one of the key factors to keep an eye on is what's taking place with respect to the supply.
Sure. Yeah. All the time. Yeah.
Let's switch gears and talk a little bit about cash rental rates.
Okay. So cash rents, again, they're up this year. And I guess in hindsight, that probably wasn't too surprising, given at the time that rents were negotiated, there was, we kind of thought things were going to be better price-wise, and we had a big crop. And so having rents go up after 2 or 3 years of declines, isn't at all surprising. And the increase, again, was pretty modest here. So finding an increase wasn't too surprising. The question is going to be, well, what's going to happen going forward? What are things going to be like next year when we get around to negotiating rents and the year after?
And so you asked that question.
Yeah, so I like to get people to share their wisdom with me as we do this. And so going forward to 2019, where are we going to be? Well, the vast majority of the respondents, the 51% there, said no change. Okay. There were 22% that were still pretty optimistic that things were going to get better and that cash rents were going to take a significant increase. You mentioned, what were they thinking when they filled out the survey? Well, here's another place where one might wonder, well, what were they thinking when they filled out the survey? The group that's more pessimistic, 27% again, says lower, about 6.4%. And so if you kind of put all those things in the pot and stir them together, I think what this says is that at this point for next year, it looks like a pretty much status quo, steady as you go kind of an arrangement. And again, that could certainly change depending on what unfolds with regards to tariffs.
Yeah, very much so. You also ask from a 5-year perspective, which I think is pretty interesting, with respect to farmland values.
Right, yeah. Yeah, so this, again, we asked them, where do you expect farmland to be in 5 years? Okay, and this year we got a significant shift in the top line in this chart. The group that said that they expected them to be higher, 52% of the group. So we got over half the folks that thought in 6 years farmland values were going to be higher. We're back into that trend that is historic, okay? Always goes up. The change, though, the 6.8% is really a small change relative to any other 5-year period we've had when land values were going up. So, yeah, we're more optimistic, may go up, but we're not going to return to the period that we had before things started coming down. So, there's cautious optimism here, I guess. Again, I think if you put all this together, things kind of say it's steady as you go. It may go up a little, may come down a little, but no big swings. If one wants to put the no change group with either the optimists, you get 82% of the groups there that say things are going to get better. But on the other hand, if you want to put the group that says they're going to stay the same with the pessimists, you got 48% of the group that says things aren't going to be so good, which is about an even split. So I don't feel bad not knowing which direction farmland values are going to go.
All right, with that, Craig, let's turn to Michael. And Michael, you've done some work with one of your graduate students in particular, looking at how cash rental rates change over long periods of time as returns to farmland shift. So let's kind of talk a little bit about those.
We're going to show this graphically, but before we do that, it's important to point out that net returns to land are considerably more variable than cash rents. Another way of saying that is cash rents tend to be relatively sticky. It takes several years in a row of very positive net return to land to drive cash rents up. That's what happened from 2007 to 2013, essentially, all the way to 2014, really. But it also takes several low years in terms of net returns to land to drive those cash rents back down. And so just because net return to land changes in 1 year, cash rent's not going to change by the same proportion. So that's very important to keep in mind. Though more variable, there is a very close relationship between net return and to cash rents. And in fact, you can explain cash rents fairly well by looking at previous cash rent. What was cash rent the last year, the last 2 years, and what was net return to land the last year, and what are the prospects for this year? And so those are very important variables in explaining cash rent. So let's think about 2019 and beyond. What are some of the factors that may impact cash rent? Well, let's look at net return to land first of all. Crop yields. The high crop yields this fall have a very positive impact on cash rent negotiations this fall and the winter. Crop prices are not so good, as Chris indicated earlier, and so those are going to put a damper on cash rent, potential cash rent bids. Ark County PLC payments are going to be close to zero, if not zero, for quite a few of the counties in Indiana. So those aren't going to be real helpful. I don't have crop insurance indemnity payments on here, but with the higher trend yields, even with the large drop in soybean price, we're not very likely on a lot of farms to see crop insurance indemnity payments because of the price drop, and so those are going to be relatively low. However, we are going to get some help. We don't know exactly how much. From the economic loss from trade payments. That's what I'm calling these payments that the Trump administration had announced a few weeks ago. And so those are going to have a positive bump. How much, we don't know yet, but we'll try to factor that in as we know more information. Production costs, I think, are flat to slightly up. And so that's going to have kind of a negative impact on net returns to land. Other factors that are important when we're looking at cash rents is, as I indicated before, previous cash rent, and then also liquidity considerations. If someone has a very tight working capital situation, they're less likely to pay more than their cost of production. They're going to try to negotiate more because they really can't afford to pay as much for cash rent, and so those are also important considerations.
Let's take a look at the returns to land over time and those cash rental rates.
And so as I indicated, cash rents tend to be relatively sticky, less variable than net return to land. They don't move as much, though the two are very closely related. And before I get too much further here, let me explain where this data comes from. The cash rents are coming from the Purdue Land Values Survey for West Central Indiana. So these are average values for West Central Indiana. And then I have a case farm with corn and soybeans that's located in West Central Indiana, and that's where I get the net return to land. There's two distinct periods here before the ethanol boom that started in 2007. Started a little bit before that, but let's say 2007 is the cutoff point there between the earlier period and the post-ethanol boom period. We can see there wasn't a lot going on. The cash rent was relatively flat because net return to land wasn't moving that much. Since 2007, we've seen considerably more variability in net return to land, and so we've seen that rise in cash rents up to 2014, a subsequent decline through 2017, and then a slight tick up in 2018. It's important to point out that even if cash rents were relatively flat in 2019, we have came down 15% since the peak in 2014. And so, so we have seen a fairly large drop in West Central Indiana in cash rent.
So Michael, as I look at that chart, what kind of jumps out at me is the stability in the first half of that chart, and then the variability, tremendous variability in the last half of that chart. And that's even a little more clear when you chop off those first 10 years and just look at the data going back to 2007.
Here I'm just showing from 2007 to 2018. And as you can see, we've seen this high net return charts before for 2007, 2013. That certainly had a very positive impact on cash rents. And plateaued in 2014, and then it's come down since then as the net return to land dropped considerably. In fact, one of the things from our model, looking at the relationship between cash rent and net return to land, we come up with an adjustment coefficient, the short-run adjustment coefficient, and so let's quantify that a bit. If net return to land dropped $100, based on the statistical relationship between cash rent and net return to land, cash rent would only drop $10. And so that gives you an idea of how little cash rent adjusts to very large changes in net return to land.
And you can see that on the chart, looking at the drop in returns from example.
We're much bigger than the drop in cash rent.
Yeah, we went from returns to land of almost $300 an acre in 2013 to 2015 was about $125.
Yeah.
And yet, cash rents came down, as you pointed out, but not very much.
Yeah, but not very much.
Yeah. All right, let's take a look at the differences in earnings per acre on corn versus beans.
I want to shift gears here a little bit because it's really changed since late May. Chris and I have talked about this quite a bit. From 2007 to 2012, for some farms all the way into 2013, corn was more profitable than soybeans. This is the case farm in West Central Indiana. For this farm, 2007 to 2012, corn was more profitable than soybeans by quite a bit. There's some pretty big bars there in 2011, 2012, $150 to $200 per acre more profitable than soybeans. And that was reversed in 2013, 2014, and the difference has been very big. It's been anywhere from about $40 all the way up to close to $110, $115 in 2017. Now we're switching again. With this drop in soybean prices that we've seen since June, it looks like corn is looking more profitable than soybeans, particularly for 2019, 2020, and beyond that period. And so kind of take a close look at this price relationship between soybeans and corn as we move closer to the planting season. And I think we're going to see some shifts away from soybeans back into corn. Last year we had 1 million more acres of soybeans than corn in Indiana. We're going to see some of those soybean acres go into corn. rotation corn in this case, which tends to be pretty profitable looking at the budgets.
And this is the time of year when a lot of people are starting to make some plans for next year. Certainly seed corn purchases are being made right now in many places.
Fertility decisions are being
as well.
made, manure and inorganic fertilizer decisions.
So it's something to think about. It's not going to be the same as what we looked at here recently, and particularly if these tariffs stay in.
The decision to plant wheat. So Michael, you've looked at wheat, I think, and it actually looks pretty promising when you look at next year's wheat prices. Very strong. There's even some talk of maybe $6 wheat possibility, but let's back off to low $5 to $5.50 wheat. And that decision, of course, has to be made fairly quickly here. Yeah. So I think we'll say, look, we're not going to push it real hard, but
it's certainly something to look at, though, because it's a big change. Because if you look at data from southern Indiana and southern Illinois, the wheat double crop soybean rotation has not been very good compared to other rotations in that part of the world. That's changing this year. I think that's a rotation, particularly southern Indiana and southern Illinois, to take a look at again. That could be quite attractive for some people.
Yeah, and we've really seen wheat acreage collapse here in the eastern corn belt in recent years.
Comeback.
So we might see some comeback, as you point out. Southwest Indiana historically had some relatively strong wheat acreage. You've taken a look at the models that you've got, Michael, and made some projections about where cash rents might be headed in 19 and also on a multi-year basis. So share those with us.
I'm calling scenario number 2 kind of a medium price scenario. This is using the iFarm price distribution model at the University of Illinois, and so that's kind of the median price. Number one scenario would be a relatively low compared to that median price, and the number 3 relatively high. And so just a little bit of discussion about those 3 scenarios. And so let's start with number 2 rather than number 1. Looking at the median prices, if these prices persist into 2019 and beyond, we're looking at some declines in cash rent. Not as big as some people might think, but at least 2% in 2019. That's higher than some of the information that Craig was sharing earlier from the Purdue Land Values Survey. The long-term impact would be a permanent. If prices were permanent that low, we'd see a drop of 13%. If you're looking at a 5-year period where prices would be $3.50 for corn and $8.50 for soybeans, hopefully they're higher than that. But if that did persist for 5 years, you're probably looking at something between 2% and 13%. Maybe that's 7 or 8%. And so that's the potential decline you could see if prices are at $3.50 and $8.50. At the low prices, there'd be even more pressure on the cash rent. It'd be a fairly large change in 2019, but a much larger change going 5 years out. In that case, we're probably looking at 15%. 5 year out if prices were that low. I'm not saying prices are going to be that low, but just looking at those are certainly a possibility. And so just looking at that scenario. Conversely, if prices return to levels that are more similar to some of the longer run forecasts, $3.75 and $9 soybeans, there wouldn't be that much pressure on cash rent. It would be a relatively small decline or stable.
Okay. I might ask Craig, what would be the implications of number 2, which, Michael, you're kind of saying that's tariffs stay in place scenario. Would land values be able to hold steady under that scenario? Your guess?
I'll let Craig answer, then I will give my opinion.
Tell the truth.
Give the right answer.
Yeah.
Would current, these $3.50, $8.50, would current prices hold land values, or we have to ratchet down?
I think there would be a bit. There would be a tendency for land values to come down if we had prices that were that low. I think there just isn't enough margin to, I think, sustain the level that we're at in terms of farmland values. Yeah. 1 year is kind of hard to really say for sure what effect it'll have on the farmland market, because people are thinking longer term than just 1 year, and 1 year it always changes. Okay, but I think certainly if prices of that nature were to go on for a couple of years, we'd see probably some movement downward in the farmland market.
I think another factor that comes in here, maybe Michael, this is what you're going to mention, but as you look at some of the other data available around the Corn Belt, University of Illinois' farm records data, the University of Minnesota Center for Farm Financial Management that's been collecting records data from farmers, one of the issues is liquidity.
Yes.
Right? And that's, Craig, you mentioned that on your survey earlier, that's getting tighter and tighter. We've been pulling down working capital now for about 4 years, and it's starting to be a different environment than what we were looking at 2 or 3 years ago.
Yeah, I think buying land today is I think the liquidity situation we're in puts the damper on purchasing land. The big factor I was going to talk about was interest rates. I think even if cash rents were relatively stable, there's still more downward pressure on land values because of the potential for further increases in interest rates. And I did some work recently on that. Even a 1% change in the interest rate would potentially reduce land values 5%. Interest rate has a huge impact on land value, and I think the people you surveyed were very concerned about that.
Yeah, I
obviously,
think that's right. Yeah.
And I think we're going to see further increases, and so I've been telling people that I expect land values to move in a different direction than cash rents. Even if we saw small increases in cash rents, land values would be stable or slightly down because of the direction that interest rates are going.
Yeah, good point. The other thing we wanted to mention here, I think, is this is a very good time for tenants and landlords to have discussions about risk sharing. This is a very uncertain environment. We've laid out what we think are some likely scenarios, but even with that, very extreme differences depending on what happens with these tariffs, truthfully. And so one of the things to think about is what level of risk sharing takes place. And one way to consider that is to think about possibly moving some of these cash rental arrangements to a flexible cash lease that's based upon revenues is probably the fairest way to do it from our perspective. Some of those flex rents, though, are based on a combination of other factors. The most common is on price. Sometimes it's based on yield, but we actually kind of lean towards the revenue model. And Michael, you've looked at this quite a bit and actually made some presentations on that, so you want to maybe share some details.
So it's Craig, but let me start here. What I've been looking at is a relatively high base, maybe a base of 90%. And so you take 10% off the market cash rent and call that your base rent. And then if returns are above budgeted costs other than land, you would share that revenue that's above. And so if you had really high yields, for example, or you had relatively high prices and that revenue went up quite a bit, you'd share that revenue above budgeted costs, excluding land. And so that's one of them that I've looked at. And one of the things about that arrangement, it does a pretty good job of kind of being halfway in between a cash rent and a share rent agreement in terms of risk sharing. You kind of split some of the risk. The share rent obviously is quite a bit of risk for the landowner, cash rent less risk for the landowner. By going to the flex rent, you kind of split the difference there. And so it's something to at least think about. And certainly with the uncertainty that we're seeing today, it seems to make quite a bit of sense.
Yeah, so that's one thing to consider, and that's why we're encouraging people to maybe start having that conversation. If you are going to make that kind of a change for this upcoming year, now's the time to have the conversation and talk that through from both sides' perspective.
Go ahead, Craig.
Yeah, I think your statement about talking things through is a really important statement. And if one is thinking about going to a flexible sort of a cash rent arrangement, there are more things to talk through. Yeah. Okay. Michael mentioned that in most of these cash rental arrangements, there's some sort of a base rent amount. The role that base rent amount plays is that it puts a floor on how low rent will go. And so where do you set that floor is really important. And then there are issues about, well, if we're going to base this on revenue, how do we get revenue? Price times yield. Well, sure. So where do we get the yield? Where do we get the price? So those things need to be talked about as well. And then, okay, if there's things are going up, things turn out better than we both expect, and we're both happy, how do we split the difference? What's left over after things start going up? And so again, some people just split it in half. I'm not sure that's the best thing to do, but those need to be talked about as well. So it is more complicated, I guess, than just saying, okay, here's the number, we're going to live with this regardless. But in all cases, there's a need for conversation this fall.
And transparency. I think that's a key word that we need to mention there is if you're gonna do something like this, make sure that it's very, very clear to all parties concerned where you're gonna get the price, where you're gonna get the yield, what does above average revenue mean even? How are we going to calculate that? And so just make sure that that's very transparent and everybody understands. Nobody wants to mess up a relationship because we didn't agree on the terms. And so when you go to flex rent, it's more complicated, and you have to lay it out.
And I think there will be an argument made to do this discussion, do this talking, but maybe this year the final decision, can we put that off until, say, next spring? We're going to have more information. That's not to say it's going to be certainty by next spring, but we're going to have more information. So there will be that could be another strategy. Let's wait for more information.
See how things play out this fall.
Yeah, that's correct. Yeah. But I think you do have to get that agreement that as a tenant, have the land for next year.
Yes.
We're just working out the final details.
Right. Yeah. All right, with that, I think we're going to wrap things up. I want to point out two things. One, if you want some more details about the Farmland Values Survey that Craig conducted, a pretty detailed write-up is available in the current Purdue Agricultural Economics Report. That's available on our website, purdue.edu/commercialag. And when you get there, just go to the Resources tab, and you'll find a link under that for the Purdue Ag Econ Report.
And tell them I couldn't get all that basis information, so where I had to get that basis information.
That's true. So also, while you're on the website, if you look at the top menu bar, you'll see a Crop Basis tool. And that's a new tool that Dr. Nathan Thompson and I have been working on along with Chris Hurt, which we just unveiled here recently. And so that gives historic basis information for corn and soybeans. Across the eastern corn belt, we cover Illinois, Indiana, Michigan, and Ohio. So take a look at that, and you'll find that maybe it'd be some help in terms of forecasting basis data going forward. And our next webinar will be in mid-September, on September 13th. We'll be providing an updated crop outlook. That'll be after the USDA's next crop production report and their next set of world ag supply demand estimates. So with that, thanks for joining us. On behalf of the Center for Commercial Agriculture, I'm Jim Mintert.